in either one, I think we go up. So I think that's great. I think we see immediate volatility. I'm thinking we could see like a red candle of 15%. I really do think that people are not, or the market is not prepared for just everyone saying the election was rigged, no matter who wins, right? Left or right or whomever. And just like lawfare and media fighting each other. So I think we're in for some unrest, and people have not priced that in yet. Welcome to another episode of the Dojo podcast, or Dojo Pod, or Dojo Cast. I don't know, could have a lot of names. It is literally election day, so we're seeing a lot of volatility in the markets. Also seeing a lot of volatility on poly market. Trump has gone up, he's gone down, he's gone up. It's been all over the place. Who knows what's going to happen? Do you have any idea of how the market's going to react? I have my own opinions, but I'd love to hear what you think.
Yeah, I mean, I feel like my opinion is pretty similar to what I've said in the past, which is that I think that market does not like uncertainty, and whichever candidate wins, I think we will likely, hopefully, in my hopium, I'm hoping we see some positive price action. I could see some initial negative reaction to Harris getting elected, and then kind of like finding some certainty through the end of the year. I think if Trump gets elected, it's probably a sell the news type of deal, and then, things settle back down, but hard to know. And I know that there's all this attention focused on poly market, and it has been an interesting tool of this cycle, but like sometimes I get a little bit, I don't know what the right word is. I get a little bit like, I think it's overused, just if you kind of start looking at the amount of slippage that you take with even just relatively small buying and selling, like the liquidity is thin. I know that they like to advertise like $1.5 billion or whatever it is. That's really volume, right? And so like, seeing, how much slippage and effect someone can have with some relatively small size always makes
this isn't too small. So I'm adding $100,000 size here, and it goes from 62.3% to 62.5. I mean, it's not unsubstantial, but what is that like? I don't know, 30 bips?
If you go down to the order book, you can kind of scroll down. I think that do they show the order book on that page?
Oh yeah, but at $1 million, you push it up like 3%.
Yeah, and things may have gotten more liquid over the last, few whiles. But
yeah, I mean, it's like the last day, so I'm sure everyone is scrambling in there to make their bets.
I think that when I was looking at this earlier, you could have Kamala Harris flip Donald Trump in terms of moving from losing to winning for something like $1.6 million, which, to be fair, very large sum of money.
Hey, for $10 million, you could do it. Let's see. What would it take to flip? 2 million? No. 3 million? No. Let's do 4 million. 4 million? 4 million does it. So for 4 million, which, I mean, in normal human life, that's a lot of money. But honestly, in crypto, we see people lose $4 million on trades all the time. I am not there, certainly. I would love to be there, but it's
crypto, let alone politics, right? They're raising hundreds of millions of dollars, right? So like the grand scheme of things,
to push the needle. Yeah. Well, I will say though, the markets are, it's like when you see a DPEG, right? And yes, it might take $10 million to depeg an asset, but then arbitragers are going to eat that up really, really quickly. So it's not that, okay, well, it takes, $4 million to flip it, because you also have to maintain that for a reasonable amount of time. So you're going to have to continuously pour money into it as people try to arbitrage the rates. But we also don't know, like, if there are political pressures continuously funneling money into these markets. I mean, we've seen some weird action.
That number we see there, like right underneath where it says presidential election winner 2024, $2.6 billion. My point is that like, I know that's volume, and I think it gets quoted too often as showing kind of like the magnitude of this market. It is a big market. Sure. It's the biggest one, but like not at the scale that like sometimes people are talking about it. That's my point. But what do you think, Stephen? I mean, do you think that we will see a big pump or a big dump depending on the...
Do we see another $1 billion of volume? Like because now it's 3.26. Yeah, so I'm kind of there with you, but I think we're going to see a ton of volatility. My own personal opinion is that like no matter who wins, the other side is going to deny it, and we're going to have weeks of uncertainty and like just be in a political purgatory for a while. We're really not going to know anything until someone is sworn in January, and then we might have some protests, and then we'll go back to life as usual, and then we can resume up only. I think either candidate wins. We'll probably see continued quantitative easing. We'll probably see continued rate cuts. Both of them want to have a good entry into the market, and in either one, I think we go up. So I think that's great. I think we see immediate volatility. I'm thinking we could see like a red candle of 15%. I really do think that people are not, or the market is not prepared for just everyone saying the election was rigged, no matter who wins, right? Left or right or whomever. And just like lawfare and media fighting each other. So I think we're in for some unrest, and people have not priced that in yet. So I hope I'm wrong. I hope that like people have already priced in the unrest. That's why the markets have been held down for so long. And once the unrest happens, people will front run the euphoric up only that happens after someone's sworn in. I hope that's the case. That would be like best case scenario. I'd be super excited. I'm with you. I think that the uncertainty is the bigger blocker. It's not a Democratic candidate getting elected. It's not Trump getting elected. It literally is just the uncertainty of who's going to get elected. And once that clears, we should have more normal price action. And again, I do think we're in for some QE. So I'm hopeful no matter who wins, Bitcoin to $100,000, definitely. And then ETH, after some serious pumpamentals, I think we'll finally hit maybe 2,800. So we're
whoa.
Oh yeah, it shouldn't be so bullish.
Yeah.
I have personally, as an aside, de-risked isn't the right word. I've diversified into Bitcoin. I'm personally doing some of the like BTC loops via Contango from layer 0. I know our risk profiles are different there, but I wanted some BTC exposure. It was a 30% APR. It's still doing pretty well. And so now I think like 15% of my portfolio is in BTC. And you know what? It feels better. Like I wish I had more exposure to it. I think that like probably a 50-50 or like 60-40, maybe even like a 60-30-10 with 10% stablecoin exposure would be an even more comfortable portfolio. But I'm getting there over time. I'm finally getting into the diversification game.
Well, I'm curious, Stephen, what was the reason that you were so heavy ETH before, right? You were almost 100% ETH. Now you've switched into being Bitcoin. Previously, you were 100% delta neutral. I'm kind of curious about how your mind works when you're making these decisions about being all one asset, all the other asset. Pretty soon we'll be hearing, 3 or 4 shows from now, he's 100% Bitcoin
Solana
or something like that.
Yeah, actually,
Solana,
I do want to diversify into Solana as well. What it really comes down to for me is what can I do with it and how much do I think people use it? So Ethereum was the de facto asset of DeFi. It was used in virtually any pair or any asset on Ethereum or any EVM was paired with ETH for liquidity. And so all of this, everything sort of fed back into ETH. All transactions got settled on Ethereum mainnet. And so it had a use case. It had value. It was, all of the best yields, all of the most like consistent risk adjusted yields were denominated in ETH. Hedge funds that we had talked to and LPs, they were looking for like ETH delta neutral plays as a side to like a stablecoin play. So it made a lot of sense to be an ETH maxi for a long time. And you know what? That narrative played out really well from the beginning of this cycle. I don't know if I can call it a bull market yet, but from the beginning of the bottom until, I don't know, about 5 months ago. And then ETH just could not, technically ETH has been down against BTC for like 2 years. So you'd have to get like a 47% APR for a while to be comparative. But that was possible with the airdrops we got, especially from a lot of the Eigen season ones. It was not unreasonable. But now we have Bitcoin, and we've talked about this in multiple podcasts. Now Bitcoin is ubiquitous. It's all over the place in DeFi. You can get a yield on it. You can get a yield on it with reasonable size. And why not? It's been outperforming ETH for 2 years now. It seems like there's no logical reason, if you felt the risk profiles were the same, which they're not, but if you felt the risk profiles were the same or approximately the same, and the yield was the same, to favor ETH over Bitcoin. Prior to this, you couldn't get those yields on Bitcoin, so I wasn't super interested in it. Holding is a very boring game for me, and I have anxious fingers. I'll sell when I shouldn't sell and buy when I shouldn't buy. So yields are really, they keep me occupied and they keep me holding when I should hold. So that's sort of my overall thesis. That's where I'm at.
Yeah, interesting. I tend to have a more kind of mixed portfolio, heavy ETH. So I have been in the same kind of goblin town as you, of course, but I have always had some BTC exposure and then a little bit of stuff like Solana and a few other alts, but also stablecoins. I typically try to hold some stablecoins, for hopefully that, 15 or 20% drop that you're predicting with the election. Maybe it'll be a time for me to buy the dip a little bit. But last question on this that you were just talking about. A couple shows ago, we talked about concerns around custodians with some of these BTC-Fi plays. What's changed your mind on that? What has made you kind of be more trusting in things like, what are you in? Is it a BTC from EtherFi, or you're muted? You're muted. You're still muted.
Ah, darn it. Yeah, so great question. I wanted to get into the PTE-BTC, but I ended up getting into the PTC-LBTC, which is also kind of cool because it gets the Lux points. So I'm really happy there. I like Lombard, so excited about that. Now there is space in the PTE-BTC, so that's cool. Now PTE-BTC is slightly more diversified. So maybe if you think that you have like too much exposure to Lombard, well, fine. You also have exposure to Symbiotic with PTE-BTC. Maybe more exposures means more risk. It really depends on how you're looking at it. But from a custodial perspective, it's either EtherFi, which EtherFi, trust them effectively with my money. I don't mind that. It's the underlying that might get a little bit more risky. So with EtherFi eBTC, you're also trusting, well, a number of custodians, right? But at the very, very bottom of this stack is Symbiotic and Babylon. Right, those are the two people you have to trust. And that's the same thing with Lombard as well. You have to trust Symbiotic and Babylon. Yes, there are additional smart contract risks, but in terms of who's custodying the BTC, it's those two people. And even those two, like the BTC being deposited tends to be wrapped Bitcoin, or I think some of them take like TBTC as well, maybe BTCB. I have to go back and double check that. Maybe it's CBBTC. So really you have to be okay with all of these different custodians. And I am. I mean, maybe like needlessly so, but most of these derivatives have like massive caches. There's not like super easy ways to exploit these. And the way that they would be exploited is what we saw with UniBTC, which I am okay. Like this sounds crazy, but I am okay with that risk vector, which is that someone gets a hold of the minting contract, mints a ton of the derivatives, and then like sells the derivatives into the LP. It's also why I'm not LPing eBTC or LBTC, because they are the ones who can get wrecked and not be compensated. Whereas the person holding the derivative is totally fine because the underlying should all be safe. And I mean, like at the end of the day, if the very, very, very bottom of these stacks is, you know, cold wallet Bitcoin held by some TradFi custodian, that's, you know, I'm fine with that.
Interesting. I have not yet dipped my toes into BTC-Fi too much. Like I have large exposure to restaking with EtherFi, you know, doing Aave loops and all sorts of stuff. I've talked about that quite a bit. And I still haven't been able to quite wrap my head around, and this is not anything about EtherFi or Lombard specifically, but like when I look at one of these assets and I see the like alphabet soup of different letters and numbers, I basically just see each of them as being their own risk vector. You know, like starting with Babylon, and then there's some custodian who has the assets in Babylon, and then you move to Lombard, and then from Lombard you move into, you know, like what would be the next step?
Yeah, this one's fun, right? So this is Babylon, then Lombard, then Corn, then Pendle, then Zerolend, then Contango.
And also, yeah, EtherFi, and also there's multiple BTC derivatives like CBBTC.
Oh, well, that would be, yeah, that would be the one over here. That would be the, if you want to do the eBTC. Right. Yeah.
So you're right. I mean, I'm probably being a little bit overly cautious, but every time I start trying to wrap my head around those things, it kind of turns me off. And so, you know, maybe that's part of the reason why I get to enjoy the pain of holding ETH. And
that's
we'll go
right.
to Valhalla.
Yeah.
You know, when ETH is just about breaking 3,000 and BTC's at like 150K, I'll still be, you know, here philosophizing about the different risk vectors of custodians and stuff.
Well,
so
let's hope.
I think it's a good trade, Stephen.
BTC goes straight up. Yeah, again, it's a smaller portion of my portfolio, but totally noted. Do be mindful of your risk profiles, and if you want to diligence these things, do your diligence and make sure you're comfortable with it. There have been a bunch of other things that have come out, by the way. So like speaking of like novel stuff, right? So BTC-Fi is pretty novel. Euler is pretty novel. Fluid's pretty novel. I want to get into both of those right quickly. Now, I did a post yesterday on Fluid, and I think they've built something really, really cool. Like they've marketed it as like you can literally squeeze out $39 of liquidity off of $1 of collateral. And that's kind of true, but there's like an asterisk there, and the asterisk should be like you can get $39 of liquidity out of $1 of collateral and $38 of lent assets. It's not, you know, you can't make money out of nothing. So this is really cool. Have you seen this?
I have seen it. And honestly, the biggest thing that I was confused about was the thing you already answered, right? Like I was always under the impression that this was limited by the lend side liquidity. And you saying that kind of crystallizes this. I understand how you can have, you know, collateral counted times leverage and debt counted times leverage, but there is always kind of this limit of like collateral plus, you know, the actual amounts that's available to be lent out, right?
Exactly.
So it is interesting. Yeah. I'd love to hear you break it down though. I feel like you're much more fluent with everything here.
So the most interesting thing, I think, from my perspective, is that both the collateralizers, they call them like smart collateral, both the smart collateralizers and the smart debt, the smart borrowers, get paid the liquidity fees. So to me, like, this initially blew my mind. I was like, how in the world could someone who's borrowing an asset be getting paid to provide liquidity? Because they're not providing liquidity. They're borrowing assets from a liquidity pool. And it took me a very long time to understand. And I don't even know if I can adequately describe it, but I'm going to try to. So basically you see here, like, we have wrapped Bitcoin, Coinbase Bitcoin. That is the LP, or effectively the LP. So when you deposit, and you can deposit whatever you want. You can deposit wrapped Bitcoin, you can deposit Coinbase Bitcoin, you can also try to deposit in the correct ratio. This is a concentrated liquidity LP. That's what it is. And so if you see, I'm clicking deposit here, you can deposit either one or any mixture of both, and they'll fix it for you, which is really cool. When you deposit that becomes collateral, which is great. You can borrow against it. It also adds liquidity to the LP. Now that is kind of intuitive. I think like no one is blown away by that. It's really cool that you can deposit liquidity as collateral. I think a few protocols have tried this before. It wasn't super novel, but it was cool. I really appreciated that. Now, again, because it's your collateral, if you deposit only wrapped Bitcoin and the ratio of wrapped Bitcoin and Coinbase Bitcoin changes, your collateral also changes. So maybe you went from like having all wrapped Bitcoin collateral, and then now you have all Coinbase Bitcoin collateral. So you really want to be okay with being exposed to either one. It is a concentrated liquidity pool, so the ratio fluctuates depending upon the ratio of the two assets. Now, here's where my mind was blown. It was on the smart debt side. It was where you borrowed the what we call smart debt. You borrowed against the LP, and somehow you were still being paid the liquidity fees for this. And so the way this works is, well, I can't really share because I don't have my position open, but if I were to borrow, let's just say wrapped Bitcoin, I'm not just borrowing wrapped Bitcoin. I mean, I am, that's what I'm going to get, but I am effectively saying I now owe, let's say I borrow one wrapped Bitcoin. I now owe one wrapped Bitcoin's worth of liquidity to this market. And so Fluid can change what I owe. Fluid can say, okay, we now have an outstanding debt, or we have like a credit of one wrapped Bitcoin. We have one wrapped Bitcoin that was borrowed out of this LP. And really where it's borrowed out of is the lenders. So the lenders lend wrapped Bitcoin, they lend Coinbase Bitcoin, they get paid an interest rate from the borrowers. So I'm borrowing wrapped Bitcoin from the lenders, not the collateralizers, from the lenders. And if someone needs to like swap into, let's just say they want to swap into Coinbase Bitcoin, what they can do is they're bringing in wrapped Bitcoin. They effectively pay off my loan. My loan converts to Coinbase Bitcoin, and they get wrapped Bitcoin out of the lending pool. So I know that sounds really crazy and complicated, but effectively what it means is you are effectively and actively providing liquidity when you borrow, because you're effectively saying you have an IOU or credit for that asset. It can be swapped through the lending pool. You can have a debt swap from wrapped Bitcoin to Coinbase Bitcoin, and therefore swappers can actively use that debt. So really cool. You get paid on the collateral side, you get paid on the debt side. Both sides are technically providing liquidity. So if you looped and leverage this, really you are providing liquidity multiple times. So 95% collateral factor, 95% LTV means 20x liquidity, means for every $1 collateral, you could have $19 of debt and then $19 additional dollars of collateral. So altogether, that would be 39x, right? 39 times your initial dollar. So for $1, you could provide $39 of liquidity and be paid for those $39 of liquidity through LP incentives. So that's really cool. I thought that was amazing. But the man behind the curtain is the lenders. They're how this all works. People who are lending to this and being paid to lend, incentivized to lend by the smart debtors.
Couple questions there. This is really fascinating. I always really enjoy seeing kind of like a new iteration or new version of some of the kind of core primitives that we're used to. A few questions. One is, why is there nowhere to lend out BTC here? Like either wrapped BTC or Coinbase BTC. I'm confused why we can't see like there isn't just like a need or a demand to like lend that out. Do you understand why that is in the system? Or
no idea. I have no idea. And maybe it is that the smart collateral is the only liquidity for wrapped Bitcoin and BTC. But I mean, here you could collateralize wrapped Bitcoin. So maybe this is effectively the same thing as lending. Maybe it's like an Aave. I don't know. So I'm not going to swear by this, but I imagine that this collateral could be rehypothecated. Most money markets rehypothecate collateral and allow them to be lent out. There is a supply rate, 1.15%, which indicates to me definitely you are being paid that wrapped Bitcoin that you supply as collateral is being rehypothecated. I don't know why it's not on the front end here, but we at least know that it can be supplied and borrowed.
And then the other question I have, so I don't typically like to do mixed delta leverage, right? I'm not trying to typically lever up my BTC or my ETH or whatever it is. But those Delta 1 pairs you were showing there a second ago, which was like wrap staked ETH, collateral with ETH, and then, yeah, these ones here, these seem kind of more interesting. Why would someone be doing this? Is this basically just the equivalent of wanting to like LP and like earn fees on both sides? So it's basically like concentrated liquidity provision times leverage. Is that the idea behind this?
Yes. Yeah. So if you wanted to provide and borrow and loop this, I'll give you a very, very simple idea, like a very, very simple case. So let's just say the borrow cost is 2%, because that's almost what it is for this wrap Bitcoin, Coinbase Bitcoin pair. So the borrow cost is 2%. And let's just say that let's ignore the supplier for now. Let's say that the LP fees are 3%. So that means that for all the liquidity you have, you get 3% times leverage, and you can get 39x leverage. So it's 3% times 39. Oh, quick math here. That should be easy. 3 times 4 would be 120. So it would be 117%. Wow, that's crazy. So it would be 117%. That's really wild. That is the APR you're getting from the fees because you've leveraged up 39x, but you're also paying the borrow cost, we're calling it 2% on your debt, which is only 19, right? You've borrowed 19x your principal. So 19 times 2 is 38. So 117% minus 38. Oh, goodness. You know what? I'm going to use my calculator here. 117 minus 38. That's 79%. So a 1% arbitrage between the LP yield and the borrow cost gets you a 79% APR. So that's why this is super interesting. This is why this is so sort of mind-blowing. Now, I think there's going to be hyper-efficient markets. I don't think there's going to be a 1% arbitrage. Also, what that also means is if the borrow rate spikes because you are so crazy leveraged, you could be in for a bad day. And I'm also not entirely clear what kind of oracles they use. That's another major risk. So you'd want to know all of this stuff before participating, and probably max leverage is never a good idea. No reason to do the 39x when you can probably, do substantially less than that and still get a decent yield. So I think that today or sometime this week, we're going to see those estimated yields pop up on the front end. So we should see actually what these LPs are generating. Are they generating 3%? Are they generating 4%? Or is it less than the borrow rate? And really, these are net negative positions. I don't know, but if they're positive, I think it'll be really, really interesting. Like right now, you can see it seems like there's $7 million supplied and $6.7 million borrowed. So this is nearly max leveraged. This is like not even $1 million. It's like $500,000 max leveraged, but it looks like a lot. They're providing a lot of liquidity is provided here. So they have $14 million of liquidity off of roughly a $500,000 deposit.
That's bonkers. Yeah.
It is bonkers. It totally is.
It's crazy because we were talking a couple weeks ago about wrapped BTC, Coinbase BTC as an interesting pair to LP on Uniswap. And then the APRs dropped off a cliff because there was a bunch more liquidity that came in. Things like this will make, even swap efficiency much more efficient on chain, especially if they can find that lend side liquidity. I'm still like a little bit confused where all the lend side comes from and how they can create demand for that. I guess they're also sharing in the benefits of receiving swap fees, which is great. And,
no, lenders do not get swap fees.
Really? So how do they make
lenders
it attractive?
Get paid by the borrowers. So here the borrow rate is 2.17. Of course, like net of fees, the lenders get that. So you can see when we were looking at the lending, or when we were looking at not smart collateral, we were looking at dumb collateral with the BTC. Man, my computer's being a little slow today, but if we're like here. So wrap Bitcoin, you can see here the supply rate's 1.15%. So basically the smart borrowers are only paying a borrow fee to the lenders, not the smart collateralizers, but the lenders. So this person who's lending and collateralizing their wrap Bitcoin, not smart collateralizing, because they're saying, I only want to be exposed to wrap Bitcoin. I don't want to be exposed to Coinbase Bitcoin. I don't want to be providing liquidity. I just want to have my wrap Bitcoin as collateral there, but it can be borrowed. So they're only getting the borrow fee. They're getting 0 LP fees. And I confirmed this like 15 times with DeFi Made Here because I was also very confused.
Fascinating. It feels like the bottleneck would be the classic bottleneck that most leverage platforms have, which is, attracting enough lend side. I can see why people would want to leverage these things up. I can see why that's very attractive. But, what are the lend rates? Would you mind just going back there for a second? We can go,
Oh, yeah, absolutely. So let's go lend. And so it looks like ETH is, 2.14, pretty low, not hyper competitive. USDC, maybe a little bit more competitive, nearly 10%. Same with USDT, nearly 10%. So really, we want to see why that is. I think there are a few reasons. One, SUSDE looping is just one of the causes here. People are assuming SUSDE. Actually, we can just look at what SUSDE's yield is here in a second, but that leverage has really pushed up interest rates across the board for stablecoins, kind of annoyingly, but also for fun. Like people are leveraging fun assets. I think also, didn't Fluid get PT assets for leverage recently, or am I crazy?
I don't think so, but that would be
I'm crazy there. And then Wrap-Staked ETH, net APR, but that's because Wrap-Staked ETH APR is 3.09 and the lending APR is effectively nothing. So, the staking APR is 2.97. Then there's like an additional 1.12. Go ahead.
It feels like everything is becoming much more efficient in the system, which is great. I still feel like the people that might be getting the short end of the stick are the lenders. And I know that Fluid has some very kind of robust liquidation engines, and that's like one of the things they pride themselves in. So that's probably why we do see $200 million of lent out liquidity, which is honestly very impressive. But it feels like for them to really scale and really see, what we were talking about a second ago with 39x efficiency on certain amounts of assets, we're going to need to see a lot of scaling as well on the lend side. So curious to see how that plays out for sure.
Yeah, I mean, I'm right there with you. I think that's going to be it is always a bottleneck. Fluid has had a history of attracting liquidity in a number of different ways. I think as long as they have interesting things to do with the assets, like go collateralize your Bitcoin for some reason to borrow against it and do something fun with it, or go collateralize your ETH for some interesting reason. Then they'll be able to attract liquidity, but leveragers always eat a lot more liquidity than they provide. And I think they're going to be, eagerly trying to eat that up if the fees are good. And so I think what's going to happen is that everything's going to normalize over a couple of months, hopefully. And what that'll mean is in 2 months, like for those months of inefficiency, the people who are benefiting from the inefficiency should be getting good yields. And we'll see if those inefficiencies exist on the supply side or on the borrowing side, but it should be relatively clear, I think, this week, who is benefiting the most from these inefficiencies. Now, I did want to check out Athena yields. We do this every now and again. So this is going to be data that is as recent as last Thursday, because every Thursday, Athena gets new numbers. So I want to see like what the actual yields are, because a lot of strategies depend on these numbers. And the two things you need is, what was the last distribution? It looks like 183,000 USDE was the last distribution. And what that means is, it's actually really good. Okay. And then we also need the total deposited, which is 1.8 billion. That's also really good. This is going to be a high APR. No, it's not. Yeah, it is. 11. Okay, that's great. So that's fantastic. That means the SUSD APR as of today is 11.06%, above 10%. I think it was as low as 4% during the really, really choppy season of ETH a month or so ago. So it's good to see we're above 10%. That also means that all of the leveraging that's happening on, let's say, through Morpho Blue, through Aave, through any protocol where your borrow cost is less than 11%, you have a positive yield. A positive net yield. So I like that. I think that's pretty awesome. You're muted.
It's amazing how Athena has kind of shifted the landscape so much for stablecoin, lend rates, and there's so many things being built on top of it. For example, if we go and look at Morpho, there's that new PT market, which just seems to be instantly filling every time there's new maker added into it. I know that there's a proposal coming out relatively soon to like mint even more there, but it's amazing to kind of see Athena really kind of long term now. I mean, they've been around, especially in DeFi terms, quite a long time, integrating into so many corners of things. So how is this not like the number one yield on Contango? I mean, I'm just looking. Maybe
there's no E mode. Okay. That makes sense. Yeah, so this would be a crazy yield, but max LTV is 72%. So by the way, for those who are just listening and not watching, I'm looking at Aave's stake USDE market, thinking that, well, if they had E mode, this would be a crazy arbitrage because it's 11% APR on the collateral and then, 4% borrow cost on like Aave's USDT. So it's a 7% times leverage, 20x leverage. You're looking at crazy high yields, but really max LTV is 72%. And if I remember correctly, 70% is 3.33 repeated leverage. So 72% is going to be around 3.4x leverage. So really, it should be like 20 to 30% APR, but it's not mind blowing, but still pretty good for a stablecoin yield plus points. So not bad. And actually, we could look at like the SUSDE markets, but yeah, there have been a lot of stablecoins that we've been seeing this cycle. Anzin, which I love to mention just because I think they're cool. Maple or Syrup, technically, both of which are around that 10% range, and now we have SUSDE around that 10% range. I think it's two things, right? One is you love to see very yieldy stablecoins, especially so different, right? So we have SUSDE, which makes its yield through a basis trade on ETH. Awesome. Love it. Kind of sustainable, does way better in bull markets. Then we have Anzin, which gets its yield from, lending to major institutions like BlackRock. Fantastic. Love it. Very sustainable. Maybe goes a little bit down when interest rates are cut, but not too much. And then we have Syrup, which gets its interest from lending to on-chain institutions like Wintermute and Ouroboros and like A16Z. Also great. These are all pretty sustainable systems with maybe they have different risk profiles, but those are completely unique from one another, and they're all hitting around 10%. So that's awesome. Then the downside of this is anyone who wants to just leverage their ETH by, collateralizing ETH, borrowing stables, converting to ETH, very, very traditional leverage, is having to pay these exorbitant borrow costs because everyone is leveraging these crazy high yieldy stables.
But on the other side of the trade, right, you've got Athena who's bringing down the funding rates on all these sexes. So maybe it's pushing traditional leverage off-chain and more of the yieldy asset leverage on-chain.
It's a decent point. Yeah. Maybe we'll see more perp adoption because it'll be cheaper to short, I think, or cheaper to hedge, whatever you're doing. I think it's a decent point. And, I've been longing ETH via perps for a while because it's been kind of efficient, but it's still very painful to see the amount of money I paid in funding. Very painful. And it makes me want to get back into DeFi as soon as possible and go for the yields. One thing I wanted to... Go ahead.
Maybe a good time to check in on JLP. I know that's kind of been a darling of this cycle of lots and lots of people going in on the JLP trade. How's it performing relative to Sol and dollars and the other things we might be measuring it against?
Yeah, so the thing that I measured against is Solana, because if you're on the Solana ecosystem and you're in JLP, the yield is intrinsic. So JLP is appreciating in value based off of the yield that it's getting. So I ignore the yield entirely. I think, okay, whatever APR you're talking about, I don't care because it's a index of assets that is gaining fees, right? So you can't really hedge it in any meaningful way because the index shifts. So really, I look at it as the asset goes up and down versus Solana. And is it better than Solana? Is it worse than Solana? You can't hedge the delta and collect the interest. So I don't even consider it as like a yielding asset. I just consider it like it is this cool thing that is kind of a hedge against Solana volatility. And if it can outperform Solana, then I'd prefer to hold it versus Solana. And here is the JLP Solana chart. And as you can see, since its inception, it has, as a trend, outperformed Solana. And I think that's amazing because Solana has had a phenomenal cycle, has done really, really well, but JLP has benefited from all of the losers on the Jupiter perp dex. So that's good. And it also benefits from Solana price action. But the interesting thing is, even though it is only 50 to 60% exposed to Solana, it's actually beating Solana so far in the past, let's get the number of days, in the past 244 days. So almost the entire year. It has since this year, it's beat Solana, which I think is really good.
Yeah, it's definitely, a very interesting one. What's the size of it these days? If you go to Jupe. What is it?
How big is it? Yeah, it's probably huge. Jupe.ag.
Is it 800 million or has it broken $1 billion yet?
I think, good question. Let's see, go to perps and then earn. No, still 861 million. So it hasn't broken $1 billion yet.
And is there more space? Well, I can't quite read the total.
Oh, yeah. Let's see. There's technically space. There's like $40 million of space.
Yeah.
And one thing that people in the dojo have been doing is they've been arbitraging it. So like JLP will get a premium, which means it's like valued at more than it's worth. And this premium will oftentimes be, I don't know what the word for it is, it'll go away fast. So you can play this game by like buying it when there's no premium, wait until there is premium, sell it, and then like just repeat that. And if you're okay with the exposures of JLP, then you can get this additional APR on top of your JLP and have an even better performing overall, I guess, like portfolio stuff. So that's been kind of cool. Right now you can see 46% exposed to Solana, 8% exposed to ETH, and then 8% exposed to Bitcoin, and then stablecoin. So it's a pretty good basket. Like I was talking earlier about being exposed to different things. Maybe it's a little bit more heavy on Solana and not heavy enough on ETH as I'd like to personally be. But of course, if you look at the Sol ETH chart, maybe it's a better idea to have this. It's not a bad asset, right? It performs well when everything goes up. It performs pretty good when things are crabbish, and it doesn't perform as bad as the rest of the market when things are bearish. So it's a cool asset, but everyone was also saying this about GLP, and GLP has sort of gone into obscurity now.
Yeah, it is fascinating to me that, I mean, this is very much the same product as what GMX had with GLP that was so popular last cycle. It was kind of like one of the big darlings. And, that performed really well until the traders started winning, right? You always have to remember that this is a counterparty vault and you are exposed to the traders' profit and losses. So, on Jupiter, it seems like the traders are really bad and they keep on losing. And that was kind of a narrative on GMX for a long time until you had people like Andrew Kang who came and won tens of millions of dollars, leverage trading ETH and BTC at like 20x leverage, right? So like you do have to kind of always be cognizant that risk is there. People always made kind of like the house always wins bets about these things, which I think is true. Like in, bearish to crabbish markets, the house does tend to always win. The problem is, and this happened to GLP, was when at the end of last year, start of this year, we had kind of like that up only mode where like the markets were kind of like very one directional, and it was easier for the degens who are kind of tend to be pretty long biased to start winning and winning and winning. It did suck a lot of kind of liquidity and trader profit and losses out of GLP. And I would just kind of caution that type of situation is of course possible to happen again with JLP. Of course, if your prediction is that we're going to still have downward to crabbish markets between now and say January, February, amazing. If you think
I think we're going to have hyper volatility, which means people are going to lose because no one can accurately play chop. I mean, not intentionally. I think anyone who happens to win during the chop just got lucky. It's just gambling. That's my own bias and opinion. But so, by all means, JLP could be interesting. But as you've said, when the markets are more clearly directional, especially if they're clearly bullish, you can see a lot of pain in those vaults. But there's also a ton of liquidity. So the bigger these counterparty vaults are, the less you typically tend to suffer from trader wins, but also the opposite is true. So your APR is going to be dramatically reduced. So at that point, it's kind of like, oh, okay, I'm getting a single digit APR that's intrinsic to the thing, but also I'm holding this really cool basket of assets.
Sure. But would you really think about it as holding that basket of assets? Isn't it kind of like holding the trader's profit and loss? Because like typically if you go look at JLP on something like Dune, so many people are, like long Sol on Jupiter. And because Sol, has been going up, but it's been very choppy, like people definitely seem to get washed out. I tend to not think about, assets like JLP or GLP as being actually the underlying assets themselves, but rather like the inverse, like it's kind of like what the opposite of what like the traders are holding, their net long and short positions. And if that nets out that they're not fully borrowing all those assets, then of course you are long BTC and ETH and Sol and whatever. But if they are fully borrowing it, then you're actually playing the counter of that, and you have a short Sol position or Sol ETH position or Sol short BTC position. Or does that make sense? Or did you really think about it as actually holding?
I don't think that's exactly right. It's because, well, okay, I see what you're saying. Yeah, because if it depends on if they lose or win though, or if they or whatever right. I see what you're saying. So it's like you're exposed to the P&L. So if they are borrowing the Solana to go short and then they get liquidated, then effectively they have to rebuy that Solana and it goes back into the pool. So it's kind of like lending, right? You're lending all these assets out, and that's what you're exposed to. So you're long all of these, you're lending them all out, and then other traders have to repay those to you. And sometimes they'll not repay you all of that because they've won and they've taken a bit of yours. Sometimes they'll repay you more because they've lost and they'll give you some more back. So I think it's more or less like you are exposed to these things. It's just that you're lending them out and you might not get them all back.
Well, what also people on, Jupiter tend to be very long Sol. So like if you're not really holding Sol because it's disproportionately people borrowing your Sol to go long with. And so
But if they're
Sol
long
goes up
Sol,
in
then they'd be
value,
borrowing stablecoins.
would they be borrowing stablecoins? I guess that's right. Couldn't they just be borrowing? Yeah. Okay. You're right. That makes sense.
And so like you're still exposed to your stablecoins, but they're being shorted for Solana, but they have to pay those stablecoins back when they close their position.
Got it. Yep. Interesting.
It's a whole headache of this is the fun stuff that's like really exciting to talk about with big nerds, but maybe is a little bit less super exciting to listeners. But for us, it's fun. I did want to while we're on Solana, I wanted to mention Jito. You know more about this than I do. There's the restaking narrative has gone from, and this is kind of ironic how this always happens, has gone from IBC and Cosmos with Celestia to Eigenlayer. I mean, technically Eigenlayer was big the same time as Celestia, I guess. Just there was less happening with the tokens to EVM world, and now restaking has come to Solana. What's going on with Jito?
Yeah. Well, not Celestia. Celestia doesn't actually have restaking yet. Of course, they will with Milky Way, which will be interesting to see when that comes out. But, restaking was mesh security, which was something I remember Sunny from Osmosis talking about, 2 or 3 years ago now in Colombia at Cosmoverse. And I remember listening to that talk and being very impressed by that. That was before, restaking was even a whisper in your average Ethereum degen's ears. But anyway, yes, we have now seen Jito launch as kind of the restaking platform of Solana. I think that they're really well positioned for this. It is a little bit different, of course, right? Where, it's not a brand new platform coming out and doing something like restaking. This is one of the biggest protocols on Solana. I think Jupiter, Camino, and who else was really big there? Drift, maybe. Jito, those are probably the top kind of handful of big projects.
Margin
so
Fi?
It's very interesting. Sorry?
Margin Fi too?
Margin Fi. Yeah, they've kind of gone down a little bit since that drama they had. Anyway, we are seeing, restaking going on. From what I understand, this is going to have a little bit of a different arc than other restaking platforms where we have to wait for points for super long periods and wait for AVS rewards to come out that still have not come out even for Eigenlayer. My understanding is that the turnaround time on this is going to be much shorter. And, it's kind of interesting to see how that dynamic's going to come out. Also, Jito is just running the underlying tech. So they're kind of positioning themselves as the Eigenlayer despite having their own liquid staking token. So it's kind of they were previously Lido. And now they're also adding on the Eigenlayer portion on top and then letting other protocols create the LRTs. So we see actually Renzo, who's been a big player obviously on the Ethereum side, coming in and creating their own LRT, which is interesting, Easy Sol. And then we see these other ones, which is KY Sol and Frag Sol, who are other kind of options. And so I think we will likely see, more and more kind of growing out in the ecosystem. You can see right now the TVL is small. Each of these, I think, are capped. So they're only at about $8 million each or something, 41,000 Sol. So not a lot of size, not a lot you can do with it, but certainly something that I'm paying attention to when potentially we can see stuff like Camino allowing, leverage, or Margin Fi allowing leverage, and you can go, long, for example, Easy Sol against Sol.
But are these going to have points? Are there going to be points for whatever the KY Sol is and whatever the Frag Sol is? I thought Renzo said they're not doing a point season for their restaking on Solana.
I think that they're not doing a point season, but
they're going to incentivize it with Res.
They're going to incentivize it with Res. I think Jito is also incentivizing stuff with Jito, and I think that we will actually see ABSs coming out. They're not called ABSs. Maybe that's
they're called
consensus networks.
Yeah.
Of course, Solana has to slightly change the name. So, you're going to have these NCNs, which are going to hopefully, theoretically, come out sooner than some of the Eigenlayer ABSs and actually start paying rewards. So that's at least the narrative I'm hearing. Less points, more real world, rewards, but we'll have to see how it kind of all plays out.
Yeah, I mean, I got really hyped about Symbiotic being faster to launch than Eigenlayer, and they really weren't. So, but maybe this is totally different. Solana definitely has an incentive to become the hegemon. If they can actually beat Ethereum in this cycle or the next cycle and get a lot of adoption, that'll be massive for them, and they will become the new Ethereum. Will that happen? No idea. Really hard to say. Their ecosystem is a fraction, and I mean literally a fraction of the size of Ethereum. But if you look at where all of the action is happening, it really is happening on places like Base Chain, maybe Arbitrum, but not even so much anymore, and Solana.
Yeah. I would push back a little bit on that Symbiotic thing you said. Symbiotic's been out for what? Not even 6 months? Like it's still a handful of months. And to
One
say
token.
that it hasn't shipped as fast as Eigenlayer, like Eigenlayer really dragged that thing out for well over a year. What, it was like a year and a half, maybe even 2 years or something like that. I'm hearing more and more that Symbiotic might be going to mainnet like before the end of the year. And if they can pull that off, then they will have
That would be huge. Now, when you say mainnet, does that mean like we'll get information about airdrops and all that kind of stuff?
So I don't know if they'll do a non-transferable thing like Eigenlayer did. I haven't heard anything about that, but mainnet means token. Yes. So I think that it's quite likely that we see, AVS is launching, probably a token launching, hopefully an airdrop, hopefully by the end of the year. And if that happens, then they will have definitely shipped faster than Eigenlayer. And also means that, for future discussions, we should talk more and more about, what are the options out there for Symbiotic. Obviously, Eigenlayer, still very attractive. If you're leveraging up something like, EtherFi ETH or Renzo ETH, on Aave, for example, you can still be getting some pretty juicy, above 20% APRs on your ETH, which is great. But season one of a lot of these different protocols, so season one of Symbiotic, of Mellow, of, different things kind of connected to that, could also be underfarmed and could be pretty juicy. So I think it's definitely worth paying attention to.
Yeah, definitely. Absolutely. Symbiotic is, again, this is like the Lido, oh my goodness, persistence, is that the right? No, persistence is a restaking protocol. Paradigm, there we go. This is them. They're good. They've been hegemons before. They could be hegemons again. So I wanted to quickly, before we end, just like show a little bit of Euler. Euler, you guys know him, especially if you follow me. We've been around the block for a while. We remember when they were like, this is the most trusted new money market. It's the Aave competitor. It's got Trail of Bits. It's got Open Zeppelin, 2 best audits in the world. And they had a new piece of code that was audited just by Sherlock before Sherlock did the Code Arena thing where they get 100 auditors to look at it. One guy, great auditor, by the way, one of the best Code Arena auditors, happened to miss a line of code. They got exploited. Everyone got made whole. Some people got even made more than whole, which is great, at least in US dollar terms. They're back. Euler is back with just a ridiculous number of audits, by the way. In terms of security, I don't want to like hype up security because Lord knows what can actually happen, but they've really, really, really invested in security this time around. And again, they already had the best auditors last time, just one poor line of code. Anyways, they're back. You can see here some crazy ROEs. ROEs is just the fancy new way of saying APR. I don't know why they went that route. It's a TradFi term. Maybe it's more accurate than APR. But I wanted to, and there's no liquidity. So don't get super excited about this. This is like $27, but they're doing a push. So they're going to be doing like an incentive package. And I love incentive packages. It means like you can go as a farmer and really benefit from these things. You're going to hear us talk about this probably more in the coming weeks as we learn more about like the royal asset, which is our oil. It's like rewards oil, and like how all this is going to work and what the actual APRs are. One of the cool things here is you can filter by a bunch of things. So they really they put in a lot of effort on the front end to make this usable for the farmer and for the strategist. And I really, from like a UX perspective, appreciate that. So let's go to liquidity. Let's say like we want at least $1,000 of liquidity, which is tiny, but just to like showcase this, some of these ROEs are still nuts. So there's $100,000 of liquidity here. That's 400% ROE on an LBTC CBBTC loop. Now, as a reminder, you need to know your oracles before getting into this stuff. Don't just ape because you see a big number. If you don't understand what your oracle risks are, you can get destroyed, wrecked, and torn into little bits and pieces. It looks like they're paying you to borrow, which is why you're getting, that's the weirdest thing. Why are you getting EUSD to borrow CBBTC? I have no idea, but you are. And so there's a lot going on over here. I recommend at least looking at it, at least checking it out. And again, you're probably going to hear us talk about it quite a bit here in the coming weeks. So get excited about that. And yeah. Mara's muted. Go ahead.
No, very cool. I'm super excited to get into talking more about Euler. Anytime money markets provide incentives, it is always a good time for farmers. So something I'm definitely keeping a close eye on, and I want to start kind of opening some test positions on. If I can get paid to leverage up, it's always a good day. So
Oh, and like final thing, Zirkit is going to give a bunch of money to anyone who had like more than 5 eigen or something. Can you like give a 30-second overview of that?
I think that everyone who had over, was it 2 or 3 eigen, gets something like $70 worth of Zirkit. That's basing it off of the current pricing that's on BitGet and a couple of other places. So
in other words, Sibblers are eating.
Sibblers are definitely eating for sure. But there is some kind of like things where you have to link your socials and do some other stuff. So anyway, go check it out. But I think we are getting close to, Zirkit being a live token, which would be great for those that have been farming that. And also Swell, I think on day after tomorrow, will be hopefully going live as well. So if you are a airdrop farmer, I hope you eat well.
Absolutely. And for everyone else, thank you for joining. Thank you for listening. Thank you for supporting. And have a wonderful rest of your day.